Welcome back. You're watching Stock Picks, and today we dissect clothing retailers. That's Woolworths, the Foschini Group, Mr. Price and Truworths with Cobus Potgieter from Southern Cross Capital. Cobus, always a pleasure. Good afternoon.
Good afternoon, Alexander. Thank you for having me.
All right, it's overall maybe reflecting on the updates that we've had out so far. Not looking like too bad of a period for our clothing retailers.
Yes, absolutely. Look, I guess we were looking for a theme here. So it's more of a pecking order than four explicit picks, I would say. I certainly don't like all of them. But all of them, with perhaps the exception of Truworths, seem to meet or exceed expectation. And we've seen them perform very well year to date, in January at least, so far, given that they were a bit beaten down over the last 12 months or so.
Let's actually start with Truworths as a counter there. Of course, I think they're reeling a little bit from the base effect. But in my mind, I've always jokingly said that Truworths is a clothing retailer by day and a financial services provider by night. So let's just also talk about that and the credit sales and how maybe that hasn't worked as well as it could for them.
So you've touched on a couple of topics, so we need to cover those. Base effects, right? So there are a couple of base effects, and both of these periods we're comparing to, which is of course the latter halves of the year, for which these trading updates typically reflect, had some nuances to them. So first off, they were stellar halves relative to the halves before, because of COVID. So there was the so-called pent-up demand. I don't know if management alluded to it as strongly at the time as they are now, but now this is what they are bleating, right? So our relatively muted performance is because of the high base from the previous period. Conversely, we had a record load shedding period in the prior period as well. That alleviated by in excess of 40 to 45% in terms of the total number of hours shed or gigawatts shed. So that affected the different retailers differently. So, and again, thanks to the sell side analysts I rely on for this information, in this case, Darren Cohen, we had around 70% backup power coverage from Mr. Price. 35%, 70% for Foschini Group, 84% for Truworths, and virtually 100% for Woolies. So those with lower coverage were more severely affected by the load shedding, and we were expecting more bounces, whereas those with better coverage would have been more constrained, more subject to that base effect that you've alluded to. So Truworths, I think, was the most disappointing of the four. It was somewhere in between in terms of the load shedding coverage. Woolies already had a relatively muted performance in terms of its local clothing business. The local food business was phenomenal, as per always. But Truworths really got bailed out by the UK operation office, which put in a decent bounce and still seems to be growing quite nicely, even though that growth is tapering. But the local operation is under severe constraint, and that is despite the credit situation slightly improving, the banking component you mentioned. So I think Truworths of the four, definitely the most muted, but of the four, definitely the cheapest. So if we do anticipate some kind of a tailwind coming through, I think given that it is so cheap and the yield is so attractive, perhaps there will be some support for that stock. So despite not having the greatest update, I think there are some tailwinds in it still.
I must ask you about management at, Truworths, having been there for a long time. Of course, that's been controversial for many years. But in my mind, though, I always worry about a key man risk and maybe the ability for them to manage themselves so well. Should there be a leadership shift there? Just keen to get your thoughts on that one.
It's a tricky one. When I started working a decade and a half ago, every time there was a rumor that Mr. Mark would retire, the stock would drop. And a few years later, every time there was a rumor he would retire, the stock would rally. So I always say that's the most, the market keeps you honest. So at this stage, it's difficult to say. The word on the street is that top management are still very involved in that process. But ultimately, I think they do have a succession plan, and if they do transition to a more modern system, which they slowly have, the fast-moving fashion versus management literally having the models parade the latest fashions for them, instead of trusting their buyers, which is something the Truworths management has been accused of, being slow to adopt fast-moving fashion. I think there's some potential upside, as things sort of evolve, from that side. But I'm loath to criticize management. It's still been reasonably well managed. That's for sure.
And then moving on, I think, to the one that I'm most excited about, that's TFG. I am super excited about what they've managed to do for themselves. In my mind, as a consumer, maybe 5 years ago, the Foschini was not a store I'd even walk into. They've really managed to turn themselves around. They've got the omni-channel platform going for themselves. Cobus, I'm very keen to find out how it fares for you.
Obviously, these are all attractive. The update was pretty good. I think better than expectation. Again, at the lower end there in terms of the load shedding coverage, so that base was supportive. If you've adjusted for that, this was more or less in line. One of the upshots, of course, and this is a nice conglomerated group, is things like the bolt-on acquisition of Jet, which is going stellarly, and fixing up those businesses is clearly delivering massively. What I dislike about this update is there's no inflation numbers, and I have a suspicion there's a reason for that. If they showed us the in-store inflation, we might see that in a like-for-like basis, they've had serious overall unit decreases in terms of purchases. So you can increase your sales by X percentage, but if that increases less than inflation or your own internal inflation, it means you're actually selling fewer units, and the market tends to dislike that because it's bad for margins. So it's tricky to say exactly where they are. The disclosure is a bit poorer than some of the others in terms of these biannual updates. So we'll have to wait for results to get a cleaner picture. But the performance was decent in the local business, at least. Australia and the UK both quite muted, I must say. Australia seems to be a running theme in terms of poor performance for both Woolies and Foschini's.
It's an interesting one there, that we're seeing with TFG being so well diversified, even across price ranges. If I think of Jet, and where maybe Foschini, the actual store, may play not quite the same market there. In my mind, that should really bode well for them, being as well diversified as they are, because they're able to capture an affluent consumer, but also a consumer looking for a discount. And based on their offering, I think that we should always see the best from them, and of course comparing them to their peers and the market conditions and so on. Am I putting too much pressure on them?
Yeah, a little bit, but the execution has been solid. Locally, at least, I'm still, like these guys are so brilliant at this, and then they go offshore and make a mess 4 out of 5 times. So, those acquisitions have been benign at best. But you're absolutely right in terms of sort of diversifying across the spectrum, and they've gone in both directions, and you're right. When I was younger, my perception was they had mostly upmarket brands, and they've really broadened that significantly. So I think from that perspective, they are doing well, both trading up and down. The likes of Fabiani's, of course, and all the way to Jet now.
And another one that's
I must also mention they are quite expensive amongst the peers at the moment. They're probably, other than Woolies, the most expensive in this group.
Which is interesting, because then I want to speak about Mr. Price, which we know really is enjoying what I might say is dominance. I hope I'm not exaggerating. It is dominating the market here at Cobus, and of course, it's because South Africans are looking for discounts. They've also made quite a few acquisitions, but really stayed within the discount retail space. I'm just keen to get your thoughts on that one here, and what you thought of the update coming out of Mr. Price.
So of the four here, that update was simply the most stellar, beyond expectation. Yes, they had that, the punishment of having the least load shedding coverage, and we need to keep in mind that something like Studio 88, a recent acquisition of theirs, was, of course, there'll be virtually zero backup power coverage there. So off that base, they've done remarkably well. And we should mention that despite having a more benign load shedding environment over Black Friday, where they tend to do quite well, we had stage 6 load shedding again in 2023. So there was just a bit of a poor blip. But over December, they certainly traded incredibly well. So just given that performance and the expected margin expectation off the back of that, we get a little bit better disclosure there. I think on a like-for-like basis across the board, the numbers have just been superior to all of the peers, again, off that base. But it looks like those tailwinds will persist and we'll continue to see it. On top of all that, it's quite cheap. It's trading at sort of a 20% trading discount to what it normally does on a PE basis. So I think at the moment, that's by far the most attractive of the four.
And I must also ask you about their use of credit sales. Could Mr. Price, extend more credit to their consumers? And would that help them at all? Or are they okay in their little niche market and really being more pro-cash?
Well, I mean, you might recall that the previous time they went into credits aggressively, African Bank happened. And suddenly financing, unsecured lending became very expensive. And I think that's going to continue to be very slow. And a couple of analysts have expected them to ramp that up more aggressively. But from that perspective, it is a very conservatively managed business. You'll see they are very cash flush at any given moment. So that's going to remain. That's going to remain quite small, and I think it suits the business model. It suits the space wherein they operate. It's better to keep things overweight cash and just tactically use credit where it really helps. It's not a shadow bank like the likes of Truworths.
Another interesting one before we move away from Mr. Price is their telecoms segment. I think that grew 9% over this period. I think it's a 13-week period. It's a part of their business that I didn't see coming, but it's possible there's some upside here, isn't there?
I think so. The market doesn't rate those things highly. It used to be a much bigger component of Foschini's as well. But the market doesn't seem to think those are high quality businesses. But I guess they're nice as and when they occur. I guess the one inside paper does quite well. So it's an interesting component, but ultimately, given the trajectory they're on, it's not going to really move the needle in terms of valuation.
Let's talk about Woolworths now, because that's on the upper end of the market. But it looks like for a while the food business has really done better than the clothing business. I'm not even sure what Woolworths clothing is doing wrong, Cobus, but I don't think they're playing a meaningful role in the way that they could.
Absolutely. So some of the low-hanging fruit in terms of fixing up that business, it's been executed, but there's a lot more. There's a lot more that needs to happen. The food business inside Woolies gets a phenomenal rating. Read one commentator saying if they strip out some of the parts, they find that the rating in that business is always the most expensive food retailer in the market, and there's good reason for that. The ROEs are amazing, the growth's amazing. It's just such a quality defensive business, and it's been supporting that struggling clothing business significantly as well. We need to talk about Country Road also, not just Woolies South Africa in isolation. That performance has also remained quite muted. That's still that again venturing offshore. Hasn't worked out well for them. Never mind the horrific base from the exiting David Jones. So, but the new management team certainly have been right sizing. We've seen the ratings improved, and we've seen some good outcomes. And this does look like a muted update, but again, they were the least affected by the load shedding. So they captured some market share. If you couldn't do your Christmas shopping at Truworths because there was no backup power, you probably walked into the Woolies, which always had it. That again was because of the food. The food so integrated into these stores that all of the stores had backup power, so the clothing businesses could keep going. So that's been beneficial, and despite that, these numbers are pretty decent against that base. So there's still a long way to go, and to some extent, we are backing management to continue fixing up that business. and it's a bit expensive, but it's high quality. That's for sure.
Now, you said there's a pecking order, so I want to rate them from 1 to 4. I know number 1 is Mr. Price. So maybe we can rank 2 to 4. In what order would you go in on these counters at this point, Cobus?
And just to be clear, this doesn't mean, this is what I would choose if I could have them for free. This is how I like them in terms of their current pricing. And even though we're not too excited about the sector as a whole, all 4 of these are reasonably attractive at the moment. But the pecking order would definitely be first Mr. Price, as you've mentioned, last Foschini's. It's just so expensive at the moment. And between Woolies and Truworths, I think I prefer Woolies over Truworths, despite Truworths being so cheap, because there are still some major potential headwinds. The credit cycle could still turn. And the other major headwind, which all of these are exposed to, that I should mention, is the issue with the ports and Transnet. The rumors are, given that, this, like I mentioned, soft update from Truworths doesn't give a lot of color, but they did provide a voluntary trading update. And the financial performance, the underlying earnings performance, is somewhat poorer than the headline revenue performance. So there are rumors that they've been flying in clothing because of the issues at the ports. And if there's the potential to see a much more severe impact from stock issues in the next 6-month period, where this has only sort of come to the fore much more recently. And of course, from that perspective, Mr. Price is the most exposed and Woolies the least, with Truworths and Foschini somewhere in between because of their offshore businesses. So, we should mention that, and I think Truworths is particularly vulnerable there. So I'm going to go with, in order of preference, Mr. Price, Woolies, Truworths, and Foschini's.
Before I let you go, our educational segment there, the difference between top-line sales growth and comparable sales growth.
Again, in line with these, because it's highly relevant. You'll see them quote these, and they love quoting that headline number because A, they are doing bolt-on acquisitions, and B, they are opening new stores. So what like for like or comparable sales does for us, and this is relevant to all companies, but particularly in the retailers, because of that moving target in terms of the number of stores that they manage, is it controls for that. We look at only the stores we had 12 months ago, and we compare the performance there. And that really gives us a sort of a much more clear picture of the operational efficiency that they've managed to squeeze, whether they're improving their trading density and how healthy the consumer is. Because if you open a new store in an area that was previously underserviced, yes, that is growth, but it isn't necessarily reflective of what your average consumer is doing. Looking at an existing store gives us a much clearer picture. And often you'll find, especially when you've recently purchased Studio 88 or Jet, that those comparable numbers diverge a lot from the headline number. So comparable sales numbers are a very useful metric to analyzing both execution from a sort of management perspective, and the health of the consumer and the willingness of the consumer to spend.
Fantastic. Always a pleasure having you with us in Stock Picks. Cobus, keep well, and I know we'll catch up again soon. That was Cobus Potgieter from Southern Cross Capital.